Welcome to the Trusted Advisor podcast, where you get a deep dive into the world of financial planning with industry leaders who share their stories of winning and learning as they charted their path to success. This podcast is for the curious, those of you that like to dig into the detail. If that sounds like you, get ready to listen and learn.
Welcome to episode 3 of The Trusted Advisor, the podcast where we explore the ins and outs of running a successful financial planning business. I'm your host, Rob Pine, and today we have a special guest joining us, Richard Hernan, co-founder of Broadleaf Financial Group. In recent years, Richard has been at the forefront of mergers and acquisitions in the financial planning industry, working closely with entrepreneurial business owners across Australia. In this episode, we dive deep into the world of M&A, discussing what drives financial planners to merge or sell their businesses, how to ensure cultural alignment, and the key steps to successfully growing your business through acquisitions. Richard shares his expertise on the factors that make or break a successful acquisition, the role compliance plays in determining business value, and how Broadleaf's unique approach to minority investments is helping businesses thrive for the long term. Whether you're a financial planner considering a merger or acquisition, or simply looking for insights into how the industry is evolving, this episode is packed with expert advice and practical perspectives you won't want to miss. So let's get started. Here's my conversation with Richard Hernan from Broadleaf Financial Group. Welcome, Richard, to the Trusted Advisor podcast. Appreciate you taking the time to have a chat about something that you're very familiar with, as mergers and acquisitions. So something that is very common now. We're hearing a lot about it across the country as the industry consolidates. And so I thought it'd be a great opportunity to have a chat to you and learn a bit more about what you've picked up along the way, given you've been very active in this space yourself. So looking forward to this conversation. And if I can start by asking you, tell us a bit about Broadleaf and your position in the market.
Yeah, thanks, Rob. Yeah, keen to be part of the podcast, and obviously an area I'm passionate about and been part of for a little while now. So, yeah, Broadleaf Financial Group is the business I co-founded with Dean Gilkison probably about 7 years ago or so now. Made our first investments around probably 5 years ago. We invest in financial planning led businesses, and we're optimized to work with owners and leaders of those businesses. So we're looking for entrepreneurial owners of businesses, and we've built our whole business model around that. So we invest as a minority, so typically between 20% and 49% in, as I say, financial planning led businesses all around Australia. Yeah, so Broadleaf, as I say, been in the market for just over 5 years. We've been at it for 7 in terms of building the business model. We've partnered with 9 businesses around Australia. And when we say partnered with, we invest as a minority in those businesses, and we're about helping but not interfering. So we sit with an owner of the business and we say, what's your aspiration? What are you trying to do? And then our business model is catered around trying to help them achieve what they're doing there. And we do that in a whole range of ways. And we do that as a business partner to that business, and we try and differentiate ourselves in that way. So we run a lean team. We try and think we're pretty entrepreneurial in what we do. So there's a team of 5 of us. So Dean Gilkison and myself are the co-founders of Broadleaf, and we're really the interface with the business owners. There's 3 parts to the business. We describe it as fund, partner, and serve. Fund is essentially the corporate finance bit. Where's our capital come from? And that's essentially a wide shareholder base of nearly 60 shareholders. Almost half of those people within the businesses we invest in. Partner is what you call the M&A piece, which we're, I think, going to talk a fair bit about today. And the third piece is serve, which once we're invested in a business, how do we help? So that's identifying what it is that the business owners have got into business with us for, and how can we help in the long term for that. And we're all about building multi-generational businesses or forever businesses, and the sort of business that can live on beyond the current owner. So whether that owner wants to be in that business for the next 10, 20, 30 years, we're trying to build a method, a framework where others can come through. We can help them and the next generation building the Broadleaf business to create these forever businesses. So it's not about a buy and flip. It's not about a listing. It's about building a community of businesses that can go on into perpetuity and help continue to serve the clients for multi-generations.
Okay, you talk about their having about 60 shareholders, nearly half of which are actually owners of businesses that have taken a stake in Broadleaf, as you've taken a stake in their business. How many transactions, merger or acquisition transactions have you been involved in?
Yeah, so there's been 9 of what we describe as hub businesses, and a hub is a standalone business with its own identity. They've got their own way of operating, and we invest in ordinary shares in those businesses. So there's been 9 of those, and then there's been another, include the couple that are settling, legals have been done and DD and everything. Include those as another 9, what we call sub acquisitions. So that's where when you're doing growth through acquisition and you're looking to find a client base or another business that'll merge into yours and help provide some more scale. And there's a number of reasons for doing that. But of those transactions, there's been another 9. So Broadleaf directly, we've had 18, what you describe as M&A transactions in that time.
Okay. And so the sub acquisitions that you are investing in, you are putting them together with the other 9 hubs. You're one way or the other, they're going and joining a hub.
Yep. Yeah, and it's not a one for one. It depends on the aspiration of the owner. Like if there's an owner that's really wanting to grow to a certain size and scale, and they want to do, 4, 5, 6, whatever number of acquisitions, sub acquisitions, we'll help find those. We'll help execute on that. There's others who are, there's no reason for them to do acquisition type work. It's more, they're growing naturally, organically, which is obviously a much cheaper way to do it. So the 9 aren't one for every hub, and we don't have a formula where we say you must or you should do this. It's all about, what's the rationale, what's the reason for wanting to, if you're going to do an M&A transaction, it's about understanding the reason for that, because blindly going into it because someone down the road or at the pub or whatever said it's a good idea is probably, in our experience, not maybe the best reason to do something.
Yeah, for sure. And now you're a proud West Australian, but I
Absolutely.
understand your geographic reach goes beyond WA now. How far afield have you gone outside of WA?
Yeah, definitely. So when we first raised capital and put our business plan together, we said we'd stay in WA. We'd made a commitment that we wouldn't invest outside of WA for the first 3 years. We stuck to that. COVID helped in a way because it meant that we probably stayed another year or so. And then we've been building a pipeline around Australia for some time, and we've got 2 investments currently outside of WA. So one in Victoria, one in Queensland. But before too long, we should have a fair coverage around Australia. We think with our business model, we can have investments in a footprint of businesses all around the major population centres of Australia. We think we've got capacity to be up to probably investments in about 50 businesses. And that's, and it seems there's a high correlation between population and financial planning businesses. It's almost 100% correlation. So if you find, any population centre seems to have at least a number of quality businesses of the, size and scale and culture that we, entertain partnering with.
Okay. And what are some of the common reasons you're seeing that a business or a planner is looking to merge or sell? What are you seeing is, if you like, the top 2 or 3 typical reasons that people are wanting to find a new home?
Yeah, there's a few main themes that go through that. So there's certainly the one where someone's really successfully running a business, but they're doing 100% of the decision rights, 100% of the risk and the pressure, and they're saying, I really want a partner in this. I don't need one, but I want a partner because I think that'll help me have a sounding board. There won't be conflict, that sort of thing. So it's the person who's done it themselves who wants to kind of share that experience. There's the person who is bumped up against, they're trying to grow and they've tried a number of different things and they're frustrated. They're bumped up against a ceiling and they really want some help. There's the person who really wants to just merge completely into another business, and that would be what we describe as a sub acquisition. And they're saying, I've got a gift for being an advisor. I love the advising, but I don't want to be a business owner. I've become a business owner because I was successful as an advisor, but that's what I've learned is it's not me. So they're saying I want to plug into something. And then probably the last really common one is a 60, 70-year-old who's getting towards the end of their career and they want to retire and they want a great home for their clients and sometimes for their team. And that's where they'll partner with and merge into another business, or we'll help recruit if it's a bigger business. We'll help recruit next gen leaders to come into those types of firms.
So on the other side of the transactions then, what are some of the key steps that businesses that need to take that are looking to grow their own business through merger acquisition? What are the key steps that you would be talking to them about? Because obviously you're helping businesses do sub acquisitions. So what are those businesses that are your hubs? What are they doing and what are you helping them do to plan for those transactions?
Yeah. So anytime someone is looking to grow through acquisition, there's a fair bit of counselling from us, and we encourage from others. Really understand yourself. Like, do you know your business? Do you know yourself? Do you know your business? Have you got a repeatable way of doing things? Have you got a repeatable culture? Because it's only going to magnify by anything becoming larger is going to magnify what it is. If you're already disparate in what you do, adding some more is just going to, again, amplify that. So it's understanding exactly who you are and who your business is, and then looking for a complementary business that's going to come in. Have you got the scale and you're looking for clients of the similar type to what you've got? And that's the most common one we see, where they've got the scale, but it's going to take a fair while organically. So it's about understanding the client type, the culture of those clients, and even the culture of the businesses they're coming from, because it's like attracts like. So if you've got a certain leader, generally your clients are going to be, culturally, quite similar. Is what our experience has been. So in terms of what to look for and what to do, we counsel on those things, and then it's about really planning it out, the transition. What's it going to look like for those clients? It's not about, you can do it on a spreadsheet, but typically the spreadsheet isn't particularly accurate. So you can really get into a fair bit of trouble by just taking on an acquisition that's not right for you, doesn't fit. It's just going to create a whole lot more work for something without generally the benefit if not done properly.
And for those that are looking for a buyer, looking for someone to sort of merge into or sell to, how do you evaluate whether they're ready for that in terms of getting maximum value for themselves in that process?
Yeah. And it's very similar in terms of that piece around running a good business. If you know who you are, do something repeatable, you do something consistent, you can describe that to, if you're the seller of, and it's typically a sub-acquisition, I think we're more talking about here, you can describe to potential buyers, here's exactly what my clients are like, here's what they value, here's how you would reduce the risk by, in your business, because it's all about reducing risk. You don't want to pay an amount of money to merge a business in that you don't know if the clients are going to stay. So, and our experience there is the better, if you like, the client base. It's been about the consistency of service provision that they've provided to those clients. The clients are really clear about what they do and what they don't do. There's a really good example of probably one of my favourite sub-acquisitions, if you like, where the owner said, I make hot dogs. I don't sell fries with the hot dog. I make a hot dog. This is exactly what I do. The clients know and love what I do, and I don't stray outside of that. And the client type was, very similar-ish across the board. So it gave that certainty to the business that was the new home for them, and no coincidence that has worked out really successfully.
Yeah. And what are the mistakes that you've seen or perhaps that you haven't been a part of, but witnessed that,
Yeah.
that buyers make in making a merger or acquisition? What are they getting wrong when they're looking for a business that they can tuck in or, bring into the fold? What mistakes are they making in that process typically?
Yeah, I think it's doing something for the sake of doing something. It's like, well, we'll be able to sort it out. You ignore the warning signs, or you're talking to, and everyone's business is fantastic. If you ask someone how they're going, they're all doing well and their business is great. But I guess being a bit too superficial, being a bit too optimistic, kind of not doing like anything in life, right? If you don't do the work, you're probably not going to get the outcome. So, and I would like to think we haven't been involved in any of these, but certainly spoken to people who've talked about, the integration hasn't been great when you're bringing people in, and particularly if they're on a different platform or they're used to a different service provision or a different pricing model. The more you compound the differences, I think the greater the risk that something's going to go wrong. So I think, nothing's going to be perfect. So looking for the perfect client base is probably a mistake as well. There's got to be some pragmatism, but it's what are the concessions, what are the things you're going to that are okay, and we've built a little bit of a matrix around that to say, here's the 5 or 6 key things you're looking for. What do you rate each of those or firstly, what do you weight each of them, and then what do you rate them? So you want to, and then that goes into the pricing as well to say, well, what are you prepared to pay for a client base? Well, if it's perfect, here's what it is. If it's not perfect but still acceptable to work on, what would it be?
You've been long-time clients of Adapt by Design.
Yep.
They're very big on culture, how to actually get the right people all aligned around culture and what do we stand for, who are we, and what do we do here, and are we all on the same page? How do you, in coming to a partnership, mergers and acquisitions on either a buyer or seller side, how do you ensure there is cultural alignment between two businesses? Have you used any of the tools that Adapt have, or how have you kind of got that cultural alignment piece prepared before the transaction takes place?
Yeah. Yeah. So yes is the answer around do we use the tools? So Adapt by Design has been a fantastic tool set for us in looking at culture, and a range of different tools within that allow us to have a good look and have a view, and Dean and I read widely, talk to a lot of people about it. But I sort of preface this whole thing by saying we actually avoid merging cultures. So we actually say there's no such thing as a merge. And here we're talking about a sub acquisition, if you like, where you've got a client base coming in, and the conversations up front are very much about if we're helping someone bring a client base in, it's very clear to the seller that they're merging in to this business, but it's merging into that business as essentially it's a takeover of that, in the way the processes and the systems and the culture and everything is going to be. And there's a very good reason for that. I feel the merging of cultures eventually ends up breaking. There's too much compromise one way or the other, and we specifically avoid merging in teams as well. We say we sometimes, or even often, have employees, team members from a business that's being purchased come across, but they come across on the basis of a job interview. There's a separate process around that. We don't just say, okay, you're just going to fit, you're going to bolt in, unless we were going to run siloed pieces within one business. So there's a couple of parts of that. One, we try and avoid the risk by not merging the cultures. We say this is the culture of the business it's going to be, and here's the client experience that it's going to be, which we believe will be a fantastic client experience. But we're not going to merge two different cultures. We're going to avoid that completely. And then with the businesses we work with, the hub businesses, we do a hell of a lot of cultural work, and we do a lot of review of that, and have a framework around career evaluations, peer catch-ups, around really understanding the people. When we're making an investment, we do what we call an org review, and as part of that, we do personality profiling. We have deep sort of qualitative discussions, and all of that is around doing DD on the culture and leadership of the business. So yeah, probably a long answer, but it's really important to us, and trying to think about is there any tips or tricks around that for people? I don't think there's any tricks. There's no shortcuts, but it's, what are the big risks that you can avoid? One, don't merge the cultures. Two, there's, if it's there's no way around that, what are the pieces of work that can be done to minimize your risk? And then within your own business, there's tools around. There's a whole heap of different tool sets, but don't wing it. Use some actual tools and frameworks that are then consistent and people understand. The culture. The short saying around that, right, is it's how people behave. Here's how we do things around here, and back to consistency. Is it consistent how people behave and do things? Have we invited a team member or two in that don't live those same sort of ways of doing things and behaviours? Now we've got an inconsistent culture, which is going to grind the gears of other team members. So I could go on all day about that, Rob. So I can short there if you like.
And the tools that you use, were they all Adapt tools, or have you kind of brought some other things in from all your reading and listening to different ways of doing things? Have you kind of had a blend of things over the journey, or has it been pretty much driven by Adapt and the tool set they've got?
I think it's been a blend of things over time. There's been experience that's been brought, but I think in anything, if you can use, and there's lots of different analogies of stuff, but typically, in my experience, people don't use 100% of the capability of anything. So if you can just use to its maximum a tool set and then blend it with other experience. So yeah, for us, we use Adapt by Design as a tool set and a framework, but then read widely. We've probably talked a fair bit about the likes of the Patrick Lencioni works, and we use the lens around humble, hungry, smart as how we sort of, when we're initially meeting people, how does that fit, and frameworks around those things. A whole range of podcasts and books and courses which complement things, but without having some sort of framework, it's just what's the latest thing that I read and try to apply. It does, that hasn't worked well for me in the past. So it's just more about have some consistency, have a framework that people can rely on, and then enhance that or complement that with other stuff.
So we catch up reasonably frequently, you and I, and we talk about all sorts of things. And more recently, we've been talking a bit about financing. Your business and our business, we both bank with National Bank, who are a major player in banking professional services firms like ourselves. What financing options are you seeing for planners out there looking to acquire another firm? Are you really dealing predominantly with the main financier, your bank, or are you seeing other financing options? I know that Judo are out there, Westpac's doing it, Macquarie certainly, always been in the market as well. What financing options are you seeing that is pure debt finance, or even maybe non-bank finance as well?
Yeah, definitely. So the main ones there, if you're doing a pure debt in acquisition of a client base, and one of the things around should I do it or shouldn't I do it? If you've got capacity in your business and you talk to a bank and the metrics make sense from a financial perspective, if you can do it as an all debt deal, it points to the fact that okay, that is improving the value of my business. If it wasn't improving the metrics or the financial ratios of your business, well, that would be one sign that perhaps this isn't the right thing from a financial perspective that we should be doing. So certainly the banks that you mentioned, so NAB, Macquarie, are probably the leading two in our experience. Westpac have apparently got an appetite, and they're certainly out there and trying to win business. Judo, people will say that they're certainly out there and winning business, and they're competing on flexibility. So they'll pitch that they're a little bit higher price on the rate, but much more flexible in terms of some of the ratios and flexibility. If you've got very low leverage already, then you're typically getting a lower price at maybe NAB and Macquarie or Westpac. But Judo is certainly winning a lot of business, so they must be doing a lot right. That's the traditional lenders, and there's definitely been a trend where there's the private credit coming into the market. There's private equity who are also providing some of the debt funds, and private credit is just a way of saying it's debt provided by private, not banks. So that's on the pure debt side, and then there's definitely an appetite on the equity side as well from. As I said before, our shareholder base, 60 shareholders, and that's all, we call it personal equity rather than private equity, but that's a funding option. There's vendor financing, which is using businesses, and certainly if you're looking as a financial planning business to merge in or purchase another financial planning business, if you are the right cultural fit for them, if you ticked a lot of other boxes, there's a conversation to be had about how much of that is in deferred payments, how much of that is essentially vendor financed. And we've certainly seen a lot of that. And that's down to the quality of your proposition. There's value in that. So you don't have to be paying 100% upfront or going through the bank for everything. It's sort of a win-win deal for if you're a great home for their clients and they want them to come to you, what can you negotiate? Would be a suggestion from me.
Okay.
They're probably the main options.
So I know that you and I both recently have had a chance to catch up with David Hines, a friend of both of ours, working with Merchant Investment Management. And in talking to David, he was talking about their ambitions to, ideally, they're looking for firms where they can offer primary equity rather than secondary equity. What he defines as primary equity is money goes into the business, it goes on the balance sheet, it gives that business the capacity to go out and grow. And it's really what you would call growth capital, as opposed to the alternative being secondary equity is really what we call succession capital, if you like, money that's going in to really get someone out, sort of buying someone who's maybe a retiring partner out. Does the structure of a deal or even the price associated differ depending on whether it's primary or secondary, or is that the valuation of the business is what it is, and there's no real difference between the pricing model and the structure of that, whether it's primary or secondary?
Yeah, for me, it doesn't make a difference to the valuation as such. It definitely makes a difference to the motivation and the want to partner with a business, depending on what your business model is. So, as you say, in the discussions with David, there'd be a bit of a red flag if the people they're looking to invest in are wanting to take all their money off the table. So similar to us, we invest from a hub business perspective. We're investing in businesses that we want to carry on for the long term. We're investing in the owner. We're backing the owner. And if the owner said, "Hey, I want to take all my chips off the table, but trust me, I'm going to hang around for the next 5 or 10 years," you'd have to go, "Well, do I actually believe that?" So it's really the willingness to actually make the investment if it's primary versus secondary. But that would be the main part of it. We're much more in the secondary market. So we're investing, which sounds contrary to what I just said before, but we're investing as a minority, and often we're not a partner in the business unless there's a way for us to invest that capital. So say 100% owner, they'll often say, "Well, what's the minimum investment?" So if that's 20%, and they'll take that investment on the basis not because they need the money, but because they want us to come in as a partner, and they believe that's going to be much more valuable to them than the 20% that they've sold. But they are getting money for that 20%. So yeah, we're much more of the secondary. The primary is where someone will come in, invest money in your business. That money goes into the bank account, and you'll use that for purposes of, essentially, you might use that to purchase another client base, or whatever it is that's a value accretive thing. So they'll use that's growth capital. So we're much more of the secondary, where we'll partner, and then we'll use the growth capital where it's sub acquisitions. A lot of that will come from banks rather than us going, "Well, here's equity capital that comes through," and we'll help arrange that financing and do all of that. But it's not about putting a whole heap of money in the bank account. It's about being a partner. The only other piece I'd add there, where you talk about the deal structure changing, whether it's primary or secondary, and this is one we bump into a lot when valuations are being done, and a business owner will often just ignore the fact that there's debt on the balance sheet, and it'll be kind of like, you go to buy a house, and the mortgage stays with the house, or they ignore the mortgage. I'm not sure which, but a business is just like a house. It's worth the equity portion. It's not worth, if your business was $10 million and you had $3 million of debt, it's, the equity value is 7. It's not 10. So that would change where that becomes relevant as well for the funding. If you had primary capital coming in and it was going to wipe out the debt, that changes the valuation. If you had ways of paying that off before, that changes the valuation. But yeah, debt is a critical part of evaluation. Although, there's been a number of instances where people would just say, "Well, can you just ignore that? Can we take that out of the equation?" It's a pretty big number.
I'm sure that'd be very handy, wouldn't it?
Yeah.
So in the transactions you've done, you've talked there at taking minority stakes predominantly, 20 up to 50%.
Yep.
Do you see some of those strategic ownership positions as being non-permanent for you? Like, do you actually buy up to a certain portion because it's needed, because as a retiring partner perhaps needs the funding to get out, the next generation hasn't got the means to do it on their own, but you become a go-between for a period of time where you would take a stake and possibly look to then really give the next generation, who are obviously going to be important for the business's continuity, an opportunity for them to then buy back off you to a portion of that you've purchased?
Yeah, absolutely. So we're situational, so we'll invest in a business, and we want to be, really clear. We want to be in there multi-generationally. So it's not situational where we make an investment and then 6 months later we've solved the problem, we're out. But how we describe it is we're elastic. So we'll go up and down in terms of our percentage ownership based on and we'll prioritize the needs of the business over our company's percentage ownership. So two good examples of that happened recently, where situationally we needed to purchase more than 50% because it was one owner owned the majority of the business, and they were retiring, they were exiting. So we held more than 50% for a period of time, and then helped them recruit the next generation leaders. and sold a portion down to bring us back to where a more natural fit as a minority. We want to be a minority owner, and we still acted as a minority even when we had a majority. But that's for the reason of bringing those next gens in. And why would we do that? People get, because there's a school of thought you just want to own 100% of everything. We're trying to optimize for how best to run these businesses for the long term. So if we've got, there's great talent within the business or external coming into the business, we're trying to optimize for ownership thinking and owners running the business. So that requires often that they need enough of an equity stake to make it a fair win-win proposition. So yeah, we've certainly done that, and we'll continue to do that into the future. And we're not trying to, we're not trying to sell that at anything other than a market price. We've got a market mechanism built into the shareholder agreement. There's certainty for people of what they're going to get now and into the future, based on how profitable the business is and how well it's run.
Yeah, sure. And having on the same subject, I was just talking to Tim Lane from FinConnect Advisory and talking about this idea about how much a private equity investor has in a business. And Tim called it a Timism. He said, I don't have the data to back this up, but his feeling was something in the order of 15 to 20% ownership external to the business, albeit they may be an active partner in helping to grow the business, but they're non-operational, or there's probably an argument to make whether they're operational or not. Tim's view was that that's kind of about the sweet spot where the private equity player has a significant enough investment for it to be worth their while, but not so much that it disincentivizes the generations that are there to grow the business and are doing the day in, day out work. Do you have a view on that? Do you share that view that Tim's got there, or do you think it's more nuanced than that?
Yeah, no, I 100% agree with Tim's view. I think it's if you're the more disincentivized the people in the business day to day running the business are, I think the worse outcome for the business. The specifics of what that percentage looks like, I think, is nuanced based on the size of the business. If you've got a much smaller business, then those percentages would be quite different. And we went through an exercise quite some time ago where we were talking about, that optimal ownership percentages, and we did a fair bit of work around, is it the percentage or is it the actual dollar amount? And it was very clearly the actual dollar amount, because you could say, well, you own 70% of a business that's worth $1 million, or you own 10% of a business that's worth hundreds of millions, right? What would you take? And it was more in that regard. And the other point was around we have this discussion a lot around active versus passive. So what Tim described there as an external owner, we don't talk about internal and external so much. We talk about active and passive, and we talk about in the small medium businesses that we invest in, we're strongly of the view that there should be no passive ownership. That's on us as Broadleaf to say, well, if we're passive, we don't have a place in your business or being an owner of your business. We should be demonstrating that us being on the share register is actively helping your business. And I'd like to think that that's always been the case. We certainly haven't had anyone come to us and say, you're not doing enough, or you are passive. So, and in future, if we have that conversation, we've got mechanisms where we'll sell down at the market price and say, we don't have any value to add. And particularly if we're squeezing out others who, it'd be better for the business for them to be involved.
Yeah, for sure. And on that, Tim shared, and he'll be episode 2 here of the Trusted Advisor, which will go to air shortly. He said he's got some slides that he was going to share in the show notes for episode 2, just around that point you've just made, Richard, which is to say having a smaller stake of a faster growing pie is always better than trying to own a larger portion of a business that really isn't growing, because you're holding up the opportunity for the next generation to come through. And it's almost a false economy thinking to hold on to the equity, and you're not really getting the motivation and ownership mindset you're looking for from your next generation. So look out for that on the episode with Tim. Over the journey, we have had a challenging regulatory environment, and hopefully there's some shift coming in that. Does compliance still play a really big part in the due diligence that you're performing? And what are you seeing that you're looking for to ensure a business is really strong in its compliance framework to make it a really good partner for someone?
Yeah, it plays a massive part. And my answer may be saying a massive part may then be strange. Probably the answer I'm thinking in my mind around, if it's such a massive part, does being a very compliant business or an exceptionally compliant business mean my business is worth more than a business that's just okay with compliance? And to me and us, it's binary. You're either the assumption before we start our due diligence is, and based on all the discussions we've had to get to that point, is that you're impeccable on your compliance. Because if you're not impeccable on your compliance, well, we don't want to partner with your business. We don't want to have anything to do with the business. So it's table stakes. You need to be impeccable with your compliance because of the financial planning industry, the regulatory overlay and framework means that the risk to us and to you as a business owner, if you don't take compliance seriously, if you're not impeccable on your compliance, what's the value in your business? The valuation is about the future income of a multiple. The multiple just represents the number of years that you're saying you have high confidence that the business is going to continue doing what it's doing on into the future. And the higher the multiple is, the higher the confidence, the number of years you think that's going to happen for. The central to that is the license to operate. If you're not compliant, you put at risk the license to operate. And in an intangible business, the value is zero, right? If you can't serve your clients, you can't earn an income. So it's absolutely fundamental that compliance is impeccable. Your question around what do we actually do? Well, through our due diligence, we review what their framework is, what the governance is around that, who's providing the advice. I had a discussion with a licensee some time ago where they talked about, and we're agnostic to whether someone's within a licensee or they're self-licensed, but we had a discussion about, you'd be crazy to be self-licensed. You'd be crazy to do, because you'd be crazy to not, or basically to do it yourself, do compliance yourself. And I said, yeah, I absolutely agree with that. You would be crazy to do compliance yourself, but you wouldn't be crazy to get a fantastic external compliance person who's got decades of experience to come and do the compliance for you. You take responsibility, but they help create all that. They have the oversight, the overview. So we're, again, agnostic to whether you've got your own in-house team doing that, an external team, but the outcome needs to be that you are absolutely impeccable. The legal framework is the minimum standard. You've got to do all the things that are way beyond the minimum standard. It's fundamental to financial planning businesses.
And we're great for acronyms in financial planning, both at the advice level, but also at the business level. We've got EBOC, we've got EBITDA, we've got NPAT for net profit after tax. What, in your mind, is the most important financial metric to consider when looking at valuing a financial planning? And obviously, one's a derivative of another in terms of net profit after tax versus EBITDA margins. But what are you looking at when you're looking at the valuing of a business? What margins are you looking at as your most important financial metric?
Yeah, so it's hard to say most important as well, but most important to our valuation. And we've got a very simple valuation. We say EBIT by a multiple less the debt that sits on the balance sheet of that business. And that's the fundamental, most important things to come to the valuation number. But that's just one number. We don't then go, that's what we're going to pay. That's the valuation. And the price then is dictated by what are the qualitative elements around that. So EBIT margin is a really important part, because that tells us if someone says they've got an EBIT margin of 15% or they've got an EBIT margin of 70%, it tells us very different stories. Almost with that one metric, you can say, well, are these people, if someone's telling you they've got a 60, 70% EBIT margin, you're saying, well, are you actually doing this with any staff? Is this business actually sustainable? If someone's got an EBIT margin of 15 or 20, is the story they're telling you consistent with that? Are they investing for growth? Are they not charging appropriately? So that's a really critical metric that we find. But in terms of other, EBOC and earnings after tax and dividend ratios and all these sorts of things, find a lot of that is, all of them need to know, but bit of noise around that. Like I'd say free cash flow is critical. If the business isn't generating cash, then that's a really important thing to know. So what dividends are being paid out historically is an important one. Are they needing to borrow to carry on the operations of the business would be a big red flag.
And the question on valuation around multiples of EBITDA or EBIT margin, what are you seeing as perhaps the most critical things that will influence the variation between a 5 or a 6 or even a 7 times EBITDA margin multiple?
Yeah, so we're not seeing huge variations in what we do, and it's in a way it's quite difficult. You sort of get deep into what you do yourself, and then you hear the commentary from others. But to see the actual evidence of what people are paying, there's kind of a bit of smoke and mirrors around. Someone says they've got this high multiple or a different number, and there's a revenue multiple, there's an EBIT multiple, there's an earnings multiple. So I think it's really important, apples for apples, to compare all those things and firstly say, okay, are we on the same? We talk about the same stuff. And then I think what dictates what the average fair multiple would be to something that's higher or much lower, there's a few different factors. One would be the percentage of the business that you're buying. If you're a business that's buying 100% of something, and then maybe revenue is the metric you'd be looking at there, but you'd be able to pay potentially a higher multiple to have 100% of that, knowing with certainty what it's coming into. If you're buying into an existing business, as we do as a minority, we believe we pay what's a fair market multiple. So I think in Australia currently, we'd say the multiples would generally be between 5 and 7. And depending on the type of business, we say, if you're buying 100% of it and it was a much bigger business, that might be 7. We come in generally at about 6 in terms of what today's valuation is. But there's certainly, if it's a fast growing business, we're able to, and this is another bit of smoke and mirrors that people can play. They'll say, I'll pay you 7 now, but the ability to be able to look into the future growth and put that at risk, you might get a much higher multiple on an apples for apples basis for doing that. So I certainly hear and read that there's US groups that are paying some crazy number, but I feel like every time we look into that, we say, okay, that was a special situation, and the company was worth $10 billion or something. If again comparing apples for apples to the types of businesses. So if there's a business owner who's operating a business that's $3 or $4 million of revenue, they've got 5 or so advisors, what's the multiple being paid on those, and to try and compare that to something where a business is worth hundreds of millions or billions of dollars, it's back to what's the certainty or the increased likelihood of repeatable profits. The bigger the business, the more repeatable, the higher the multiple someone can pay. And then the other side of the multiple equation is for someone to pay a higher multiple, that's a percentage return they're expecting on your business. So if someone comes to you and says, I'm going to pay double what someone else pays, you say, okay, well, how are you going to get a fair market return from that? Is it because you're taking my clients and you're vertically integrating them, you're going to charge them double? What is it? So it's about, I think, being curious on that. But I think circling back to your question, what am I seeing in the multiples? I think in the 5 years or so, the last 5 years, it feels like the actual EBIT multiples have remained pretty steady in the sort of size and scale of businesses we've looked at. The revenue multiples for the 100% sale of a retiring owner, the merge in, that seems to have fluctuated a little bit from back where you had client bases that weren't really, there wasn't really a lot of service being provided. It seemed like those multiples drifted up, some time ago, but now it feels like they've gone away, and now they're genuine client relationships, and those multiples, I think, vary a little bit, but it's within a fairly tight band, which, without quoting numbers, that doesn't seem to have changed. Like we just say, what's the market multiple? And we look at Radar results, which publish on their website. Here's based on age criteria. Here's the high and low range. And that's, we look at that as what we see as the market.
Do you have any thoughts or comment to make about, as we wrap up here, what trends that you're seeing in the M&A landscape? You've been in this a while now. What trends have you seen that you would comment on that are showing up in the financial planning business landscape in Australia?
If anything, I'd say there's a trend where there's, I guess, a maturing offering or a different or wider range of solutions. So I think maybe as we were getting into it, there was the option really of don't sell or sell to someone who's going to buy 100% of your business and merge it in. There's certainly us and some others are doing the minority investments where you can carry on the business as it is. You definitely have some overseas investors now who are, things have gone well in the US and and the UK with financial planning business investments. And they've said, okay, well, Australia's a pretty steady market as well. So there's been a trend of that. And I think it gets picked up more in the media than what we see day to day. I mean, we don't see a lot of it. You see some, and I think until someone's actually been in the space for a number of years, like an overseas competitor coming into Australia for a number of years and showing that sort of commitment to space, do you take them seriously? And I think that, so there's a handful of those that have been here long enough to go, okay, they're a viable option. They're committed to it. And yeah, so that's sort of the overseas as a theme, and private equity taking a bit more of an interest, I think, is a theme that's grown. And there's definitely, I think, just with better access to information, there seems to be, I don't know if it's more or less, there seems to be more talk of M&A activity now. Whether that translates to more being done, I know there was the theme after the Royal Commission with going from 28,000 advisors down to 15,000. There was going to be a tsunami of clients coming onto the market for sale, but it seems like a lot of those numbers were, accountants with financial planning or classified as a financial planner or whatever. Thankfully, there seemed to be more of a steady state of transfer of some of those client bases. So I think they're the main that I'm saying.
Well, we'll wrap up there, Rich. I just want to say in closing, congratulations on building a terrific business in Broadleaf Financial Group. You've obviously been able to win the confidence of a number of people through the reputation you've established over multiple transactions now and building strong partnerships. And so it's been great to witness as someone who's kept obviously in close correspondence with you, and we catch up frequently. But yeah, I just want to say well done on you and Dean building something terrific. Obviously, you've got some really committed shareholders there now and helping to fund the growth that you're experiencing. So a great success story. And obviously you're finding people that want what you're bringing to the market, which is a stable long-term partner that can support their growth ambitions or succession plans, as it might be.
Yeah, thanks. It's been great to chat in this setting. Thanks very much.
Terrific. Thanks, Rich.
Thanks for listening and learning with us. For a complete list of episodes, show notes, transcripts, and more, go to thetrustedadvisor.com.au.